Alright, let's play a game. Imagine you have $1 billion. Yes, billion with a B. How would you spend it? Mansion? Super yacht? Private island? Great choices. But what if I told you that the ultra-rich don't just spend their money like that? No, no, no. That would mean paying taxes, and billionaires hate taxes more than we hate Monday mornings. So instead, they use a secret wealth strategy called buy, borrow, die. Yeah, that sounds like the title of a James Bond movie, but trust me, it's way more profitable. By the end of this video, you'll understand how the rich buy assets that make them richer while you sleep, borrow cash without ever paying taxes, and die in a way that keeps their wealth and the family tax-free. Sounds unfair? Yeah, it absolutely is. But guess what? This is completely legal. They're not breaking any rules. They're just playing a different game than the rest of us. Let's break it down for you. Step 1. Buy stuff. But not just any stuff. No, not clothes, not iPhones, not even a car. We're talking appreciating assets, stocks, real estate, companies, even priceless art. The kind of things that go up in value over time. Let's break down the types of assets the wealthy prefer. Equities. Stocks, especially those that pay dividends, so they generate income without being sold. Real estate, commercial properties that bring in monthly rent while appreciating in value. Private business ownership, businesses that generate consistent profits and grow over time. Alternative investments, fine art, collectibles, and other assets that tend to increase in value. Here's the trick. The rich never sell these assets. Why? Because selling means paying capital gains tax. And we can't have that, can we? Instead, they let their assets grow in value. Stocks go up, houses appreciate, businesses expand, and boom, they're worth more on paper. But no taxes are owed because they haven't realized any gains. Let's take Warren Buffett, one of the richest men in the world. You know how much salary he takes from his company, Berkshire Hathaway? $100,000. That's it. Most middle managers make more. Meanwhile, his company is worth hundreds of billions. But since he doesn't sell his stocks, he doesn't pay taxes on their growth. Smart, huh? Think about it this way. When you get a raise at work, you pay income tax immediately. But when Buffett's stock portfolio goes up by billions, he pays nothing unless he sells. And guess what? He almost never sells. This is why the wealthy focus on building equity, not income. Income gets taxed at rates up to 37% plus state taxes. Long-term capital gains, maximum 20% federally. And if you never sell, 0%. See the game they're playing? It's brilliantly legal and completely unfair. Chapter 2. Borrow. Free money, no taxes. Alright? So the rich are sitting on a mountain of valuable assets, but they don't sell them to get cash. So, how do they pay for their lavish lifestyles? Easy. They borrow against their wealth. Let's say a billionaire owns $10 billion in stocks. Instead of selling, they walk into a bank and say, "Hey, give me a $500 million loan against my stock." And the bank, being the best buddy of the rich, says, "Absolutely. No questions asked." These aren't your typical loans. They're called asset-backed loans or securities-based lines of credit. And they come with some incredible perks. 1. Super low interest rates, often just 1 to 2% above prime rate, because these are considered low-risk loans. 2. Flexible repayment terms, sometimes interest-only payments for years. 3. No spending restrictions. Want a yacht? A mansion? No problem. Why this works? Loans aren't considered income, so they aren't taxed. They still own their appreciating assets, so they keep getting richer. The interest may be tax-deductible if the loan is used for investment purposes. They can use new loans to pay off old ones, creating a perpetual borrowing cycle. Let's compare two millionaires. Millionaire A sells $5 million in stock to buy a house. They pay roughly $1 million in capital gains tax, leaving $4 million for the house. Millionaire B takes out a $5 million loan against their stock. They buy the same house, pay zero in taxes, and their stock keeps growing in value. 5 years later, that same stock might be worth $7 million. Ever wonder how Elon Musk was able to buy Twitter for $44 billion? Did he just Venmo the money? Nope. He used his Tesla stock as collateral to take out a huge loan. That way, he got billions without selling his shares and, guess what? Without paying a single cent in taxes. And it's not just billionaires. Many wealthy people with assets worth millions use this strategy every single day. They live in multi-million-dollar homes, drive luxury cars, and take exotic vacations, all financed through loans against their investments. Must be nice, huh? Your credit card charges 18% interest while they're borrowing at 3%. See the difference? Chapter 3. Die, the ultimate tax hack. All right, here comes the genius part. So, the rich never sold their assets and borrowed tax-free money their whole lives. But what happens when they, kick the bucket? You'd think the government would finally get its cut, right? Wrong. The rich use a final trick called the step-up in basis. What is the step-up in basis? In the U.S. tax code, there's this incredible provision called step-up in basis at death. Here's how it works. Let's say Grandpa Billionaire bought stocks for $1 million, and when he dies, they're worth $50 million. Normally, if you sold them, you'd pay capital gains tax on the $49 million gain, but thanks to the step-up in basis, his heirs inherit the stocks at their new market value, $50 million. That means if they sell them immediately, they owe zero taxes on that $49 million gain, like a reset button on capital gain. Poof! All those years of growth, gone. No tax bill. This is exactly why wealthy families can pass billions from generation to generation, while middle-class families struggle with estate taxes on much smaller amounts. But wait, there's still estate taxes, right? Yes, but what's the estate tax? If someone dies with an estate worth more than $13.61 million in 2024, the amount above that is taxed at 40%. That includes real estate, stocks, businesses, basically everything. For example, if Grandpa's estate is worth $50 million, the first $13.61 million is tax-free. The remaining $36.39 million gets hit with a 40% estate tax, $14 million in taxes. Sounds brutal, right? But the ultra-rich have ways to avoid this too. They use sophisticated trusts and estate planning strategies to legally minimize or eliminate estate taxes. 1. Irrevocable life insurance trusts, ILITs, provides tax-free payouts to heirs. 2. Grantor retained annuity trusts, GRATs, transfers wealth with minimal gift tax. 3. Family limited partnerships, FLPs, transfers business interests at discounted values. This is exactly what happened when Walmart founder Sam Walton passed away. His heirs got Walmart stock at the new stepped-up value, avoiding millions, actually billions, in taxes. And guess what? Walmart is still family-owned today because of this trick. The Walton family is worth over $200 billion today. Yes, they worked hard to build the company, but this tax strategy is what allowed them to keep almost all of that wealth in the family. Meanwhile, if you inherit your parents' house that they bought for $100,000 and is now worth $500,000, you get the same step-up benefit. The difference? Scale. Your tax savings might be $80,000. The billionaire's family? Billions in tax savings. See how the game is played? Let's recap the buy, borrow, die strategy. The rich buy assets that grow in value and generate passive income. Instead of selling and paying taxes, they borrow money tax-free against those assets. When they die, their heirs inherit everything with a stepped-up basis, wiping out any capital gains tax liability. This cycle repeats for generations, keeping rich families rich forever. Meanwhile, the rest of us pay taxes on every paycheck, every sale, every little thing. Our wealth building is slowed by taxes at every step, while the ultra-wealthy use these perfectly legal strategies to accelerate theirs. Now, is this fair? Many would say absolutely not. But it's also important to note that these are legal strategies available in our current tax code. The wealthy aren't breaking any laws. They're just playing the game differently because they know the rules better. What can you learn from this? Well, while most of us won't be billionaires, understanding how wealth really works can help you make better financial decisions. Focus on acquiring assets that appreciate over time. Understand the power of leveraging those assets. And yes, learn about estate planning, even on a smaller scale. The rules of the game are there. You just have to learn to play smarter. Thank you for watching. If you really want to know what Bitcoin is and how it actually works, you need to watch this video.